Hello and welcome back to Money Moves Daily, your China-Hong Kong briefing. It's Wednesday, September 3rd, 2025. I'm Sophia Reyes.
And I'm Jason Miller. Sophia, it's a bit of a mixed bag out there, isn't it? The Hang Seng and Shanghai Composite are both a little in the red this morning as investors digest a flurry of new data and policy moves.
Precisely, Jason. We're looking at an economy sending some seriously mixed signals, despite Beijing's continued push for stimulus. Today, we're going to dissect China's two-speed economic recovery, the fierce battle raging in the tech sector, new AI content rules, and some significant geopolitical alignments.
Sounds like a packed agenda. So let's get right into the big story. What's really driving the market sentiment today? We're seeing some positive news, but also a lingering sense of caution.
The market's caution stems from the unevenness in China's recovery. We just saw the Caixin Services PMI for August unexpectedly rise to 53.0, up from 52.6 in July, beating expectations. That suggests resilience in the services sector, which is positive. However, on the manufacturing front, the NBS manufacturing PMI actually only edged up to 49.4 in August from 49.3 in July, missing expectations and marking its fifth consecutive month in contraction.
5 months. That's not exactly a booming factory floor, is it? So we're seeing strength in services, but continued weakness in manufacturing. What's Beijing's play here to get the whole engine firing?
Exactly. The government is clearly trying to boost domestic demand. Caixin Global reported that China has rolled out new subsidized consumer loans aimed at increasing spending on everything from cars to healthcare. It's a direct attempt to inject confidence and liquidity into households, hoping to translate that services sector resilience into broader consumption growth. This comes after the PBOC kept benchmark lending rates unchanged in August, suggesting the focus is currently more on fiscal and targeted support rather than broad monetary easing.
Subsidized loans sound good on paper, but after years of headlines about a sluggish property market and consumer confidence issues, will people actually take them up? Is this enough to make a real difference, or are we just papering over deeper cracks?
That's the billion-dollar question, Jason. The impact remains to be seen. It's a key part of their strategy to rebalance the economy. But stimulating demand requires more than just cheaper loans. It needs sustained confidence and income growth. Which brings us to our next segment, market movers and trends, where the picture is similarly bifurcated.
Speaking of bifurcated, let's talk about the tech sector, because recent earnings paint a two-speed picture, right? I heard Tencent had a solid quarter, but some of the e-commerce giants are really feeling the squeeze.
Absolutely. Tencent Holdings delivered stronger than expected Q2 '25 earnings, with revenue up 15% year-on-year and net profit rising 17%. Their gaming business, both domestic and international, saw robust growth, and their advertising revenues surged 20%, partly due to AI-driven efficiency. They're actively investing in AI, showing that innovation can still drive significant returns.
So Tencent is riding high on gaming and AI. But what about the others, like Alibaba or JD.com? Are they just stuck in a rut?
Unfortunately, for many e-commerce players, it's a much tougher environment. Companies like Alibaba, JD.com, and Meituan are grappling with intense price competition and weaker consumer spending. It's a battle for market share, and margins are shrinking. We also see this in the EV sector, with BYD facing an intensifying price war that's eroding profitability.
It sounds like a survival of the fittest in certain segments of the Chinese economy. If you're not innovating or vertically integrated like BYD, you're in for a rough ride.
Absolutely. Meanwhile, companies like SMIC are benefiting from Beijing's push for technological self-sufficiency, particularly in chips. It underscores a strategic divergence in the market where state-backed or strategically aligned sectors are finding support, while consumer-driven segments face fierce organic competition.
Let's switch gears for quick hits. Give us the rundown on some other noteworthy headlines.
First up, China has officially enforced new AI content labeling rules. This means AI-generated content must now be clearly identified, a move to curb misinformation and ensure transparency in the digital space.
That's a big step for AI governance, certainly something to watch as AI proliferates globally. What else?
In Hong Kong, a former UBS banker was just sentenced to 10 years in jail for a $17.2 million money laundering scheme. It's a stark reminder of the ongoing efforts to maintain financial integrity in the city.
Good to see the regulators aren't letting up. And on the international stage, what's happening?
President Xi and Jinping held talks where Xi hailed win-win ties, solidifying a 30-year gas deal. Beijing is also pushing for a development bank within the Shanghai Cooperation Organization to help Eurasian countries curb reliance on the U.S. dollar. It's a clear signal of deepening geopolitical and economic alignment.
That's a significant move, certainly impacting global trade and currency dynamics. And a final quick hit?
The HKMA has granted a restricted banking license to ABN AMRO Clearing Bank NV. This indicates continued activity and confidence in Hong Kong's financial infrastructure, even with broader market shifts.
All right, Sophia, as we wrap up, what should our listeners be keeping an eye on for the next 24 to 48 hours or even this coming week?
Given the latest economic data and policy announcements, the market will be closely watching for any further indications of how Beijing's new subsidized consumer loans are being received and whether they can genuinely stimulate retail sales in the coming months. We'll also be tracking whether the two-speed trend in the tech sector intensifies, especially with the ongoing AI investment and the relentless e-commerce price wars. The broader U.S.-China trade tensions also remain a constant undercurrent.
So it's all about execution and impact now, seeing if these measures actually move the needle for the average consumer and the struggling parts of the economy.
Exactly. It's a complex picture, but that's what we're here to break down daily.
That's all the time we have for today. Thank you for tuning in to Money Moves Daily, China, Hong Kong.
Be sure to subscribe wherever you get your podcasts and leave us a review to let us know what you think.
We'll be back tomorrow with more crucial updates. Until then, keep an eye on those money moves.